Hello and welcome to Energy Unplugged by Aurora. This podcast features various experts from Aurora having in-depth conversations with key industry leaders, policymakers and academics from all over the world. It explores the hottest topics across the energy market and gives a unique perspective on major energy issues. This is the fourth and final episode in a series on global project finance, organised in partnership with SMBC Group, with the episodes covering Europe, Australia, Asia and the US. This series is hosted by Aurora with guests from SMBC, various law firms and Aurora.
Welcome everyone to Energy Unplugged. I'm Julia, who's Aurora's head of USA East. We're very much looking forward to today's discussion, which is part of a series in collaboration with SMBC Group on project finance globally. So far, we've had focus areas in Europe, Australia, and Asia, and today's focus is on the US. You'll notice some universal themes across the conversations, but of course, today I'm particularly excited to tease out the unique environment we've had in the United States here since the passing of the Inflation Reduction Act, which recently had its one-year anniversary. I'm joined today by three phenomenal guests. I've got on the line Carl Morales, who is the Managing Director and Group Head for the North American Power Project Finance Group at Sumitomo Mitsui Banking Corporation, SMBC, where he's been for over 30 years. His team is responsible for originating, structuring, negotiating, and executing energy and power project transactions in the United States and Canada. Over the course of his career, Carl has been involved in the financing of solar, wind storage, and a variety of thermal power projects across North America. Welcome, Carl.
Thank you.
I'm also joined today by Ron Erlichman. He's a partner and co-head of energy and infrastructure in the Americas for the law firm Linklaters. He focuses his practice on all phases of the development and financing of energy and infrastructure projects, including renewable energy, thermal power generational facilities, transmission facilities, among others. His clients include lenders, sponsors, private investment funds, and developers. Welcome today, Ron.
Thank you, Julia.
And finally, I'm joined today by Oliver Kerr, who's the head of our North American business here at Aurora Energy Research. He has experience working on renewables, storage, and conventional generation in both the US and Europe. Welcome, Oliver.
Great to be here, Julia.
To kick off today, then, I'll focus on something I said in the opening, which is that it's about the one-year anniversary of the passing of the Inflation Reduction Act. So it's been a really busy time in power in the United States. Carl, let me start with you. What does the project finance space look like right now in the US? I suppose the question gets at the overall level of activity that we see now, especially in comparison to a year ago or prior to the Inflation Reduction Act.
I would say that the project finance market, even leading up to the IRA, was very active, especially on renewables. Mostly driven by the strong interest for and focus on ESG. We obviously have seen the IRA give a tremendous boost. I mean, I think the biggest part of it that was a main focus was obviously the extension of all the existing tax credits that were in place. But obviously, they've opened up the door to now really give a tremendous tailwind to the industry. And I would say, like over the last year, we have seen a lot more focus, a lot more investment in the space, and where we're seeing it is not only your traditional IPPs, but regulated utilities as well, and also corporate America. I think has really embraced the need to source its electricity from renewable sources. So we have seen a tremendous uptick in deal flow at all stages. I would say mostly greenfield renewables and mostly solar, wind, and battery storage. But I think the last year has really shown that the power market here in the U.S. is up for a big investment in the renewable space, and also to transition away from traditional thermal fuels. We'll see how long that will take, though.
Yeah, it's fascinating, Carl. I'll definitely echo what you said. I was in an event in the UK about a year before the passing, and I think the US was a little bit of an afterthought when we talked about investment in renewables, and then a year later we were one of the headline events. So everyone was very, very excited. And I want to touch in a little bit as well on some of the specific technologies that you teased out, because I think that will yield some interesting conversations. But before I do that, Ron, let me just pass that same question back to you. Does that experience resonate with you? Are you seeing a similar level of uptick in activity from a place that was already quite active prior?
Absolutely. I agree with everything that Carl said. I think that the U.S. was already on a trajectory, a path towards the transition from fossil fuels, and also a heavy interest in ESG. And that was, while the tax credit regime definitely facilitated that, I think there was an independent movement just from a sensitivity in the corporate climate to needing to be aware of the issue. The IRA just provided a tremendous tailwind to the market as a result of that. It's like taking the overseas flight to see my colleagues in the UK and shaving off an hour or two of it if you happen to have a good strong wind. And it's really been a wonderful thing to see. But it's also had the effect of, as you were describing, Julia, of increasing tremendously the interest from folks outside of the United States to the US. I think the US is often viewed as a fairly stable and safe investment environment and has always attracted capital from around the world. But I think there was a sensitivity to the uncertainty that exists in the renewables market in the US as a result of there's constant, are the tax credit regimes going to expire? Do we have to worry about a change in administration, et cetera? And so the certainty that the IRA has provided with respect to the US's commitment to energy transition has really amplified the interest from overseas in the US.
It's a fascinating dynamic, Ron, that you're touching on, that a lot of Europeans especially will tend to be familiar with a system where there's more centralized planning. And here we have seen those pushes from private investors, from corporations, like you mentioned. And this is one of the first times that we've seen such a strong coordinated push that provides that level of clarity as well. Let me stay on one of those very unique features of the US market that you've already hinted at as well, which is tax equity. Very, very unique to our particular system. And we have a global podcast audience. So Ron, can I throw that question back to you to just explain a little bit of the basics of how tax equity works for someone who might not be as familiar, and then help us understand, where do we have clarity now from the Inflation Reduction Act on how that works, and where are we still waiting on some guidance?
Happy to. I will confess that my partner, Judy Kwok, who's our tax equity expert, always shudders when I start talking about tax equity if I get too far into it. But having been involved in the renewables market for almost 12 years now, I've had to, learn the regime. And as you said, it's something that is very unique to the United States. The simplest way to think about it is offering an opportunity to someone who has what we tend to refer to as tax appetite, meaning I have taxable income that I would like to offset against, or taxes that are owed that I would like to offset against, and an opportunity, if you structure it properly, to invest in renewable assets that will, and now other transition assets that will allow you to offset that tax liability. In order to do so, you invest in a project as an equity participant, and instead of focusing on receiving cash, as would typically be the case from a cash equity participant, you're allocated a substantial portion of the tax attributes, which would be the tax credits and depreciation, accelerated depreciation. So it's a regime that has existed in the U.S. for several years now, and the IRA has just provided a bit more clarity, certainty as to the longevity of the regime, and also included different opportunities to increase the sizing of the tax equity investment that participants can achieve.
Thanks for that, Ron. So then I'll pass it to Carl. How should we see the role for different investors and lenders then in the project space? I think traditionally, based on what Ron has explained, that those investors need to have fairly substantial tax liability. It's been a couple of players, and so conversationally, we maybe have called them bottlenecks to date, right, in the system. Carl, is that still what you're seeing, or might you add anything to that or change that, what we're seeing now?
Yes. So in the renewable space, I mean, tax equity has played a tremendous and important role in completing the capital stack for the financing of the projects. So even though it's, technically equity, it's another financing stream to essentially monetize that tax credit. And so the industry and our clients have needed it in order to get their projects financed and built. And I think you mentioned the word bottleneck. We've seen that. So as more activity has picked up in this space, there's only so much tax equity appetite out there, or human capital, human resource capacity to handle it. I mean, right now, it's currently around a $20 billion business, and there's, with the increased deal flow, there's concern that these deals, that all the deals will get the tax equity that they need to get them built. The transferable credit obviously opens that up tremendously to the non-traditional players that we've seen in the past, which have been, for the most part, large money center U.S. banks. But we have seen some non-traditional players get into that space. But I think what the IRA does, some of the benefits, is that it gives more structuring flexibility. It opens up the takers of the purchasers of these credits, and then it will probably most likely simplify the structures. And we're starting to, the last year we've spent a lot of time with the transferable credit and looking for ways to lend against it, because that's essentially, in our space as a commercial bank, we're right now we're providing back leverage to a complicated tax equity partnership flip structure, which obviously has developed into a very stable product. But now the transferable credit will kind of give more capital to the industry so that we can keep up with the pace of putting renewables in the ground.
That's a great point that Carl made, and you described it as a bottleneck. There was some talk prior to the IRA passing about the construct of having a direct pay regime that was available for everyone. So that would have opened up the market tremendously. Obviously, that didn't happen, and I won't get into taking sides as to why it did or didn't. But while we have some direct pay for certain types of resources, for the most part, it's just the transferability, which has the inability to capitalize on the full tax attributes because you don't get the transfer depreciation. But it's interesting. It's not as much of a lack of capital, but as Carl pointed out, a lack of human resources, where the large money center institutions that have historically participated in the space can only deploy so much because of you sort of need the biggest bang for the buck when you do a deal. And so it concentrates the capital in certain types of transactions and potentially with certain types of sponsors because of the deal flow that they have. But I think that the transferability is going to help ease that. And I think that corporate interest, but I know, Oliver, if you sort of agree.
Yeah, I mean, look, I think it's an interesting question, right? And I think the scale of the challenge is enormous. I think Carl mentioned the tax equity market, something like $20 billion today. Per our analysis, the IRA could increase that to something like $50 to $80 billion by 2030. So, when it comes to actually monetizing those tax credits, I think transferability definitely does help. But like you say, there's a human resources challenge. It's not a silver bullet. Some of the reasons Carl mentioned around, how do you actually finance against it? But some of the difficulties you mentioned around monetizing, accelerating depreciation. So I think there's still going to be an important role for traditional tax equity partners. The question is, to what extent will they be able to step up to meet the demand and absorb those new tax credits in the market?
And just to add, I don't think it's going to remove current players. It's just going to add more. I mean, what we're seeing now is we are seeing those banks, playing in the transferable credit space as well. So it's, from a contracting perspective, and it could lead to, other, business lines as far as like placing the credits or brokering them. So it does, we don't see the existing players going away. Project finance, the power project finance space is a relationship business. And those traditional players are, our partners to our clients. So even though they are, sometimes viewed as the most expensive source of capital, they still are, an important piece of the puzzle.
I'm hearing really clearly across all three of you that two of the biggest changes and benefits so far have, one, been that increasing access to the space that opens up to new players, doesn't necessarily rule out existing players, and certainly keeps them very active. And then the second piece, Ron, that you touched on was predictability and visibility into the space in future, where that's been somewhat limited in the past. Oliver, can I pivot that over to you? I think a third big question is then the ability to actually not just deploy the capital, but to actually build on the ground. So I think in order to do that, we have to probably look at particular parts of the United States. We say somewhat jokingly sometimes that investing in the US is like investing in Europe, because we're a bunch of separate countries, even, right? Separate markets over here. For example, a lot of our markets are dealing with interconnection queue issues. FERC has recently issued an order that's asked markets to clean up the way that process operates. There's interaction with state level policies, and in a lot of states we have decarbonization goals, renewable energy certificates, et cetera, that are pushing the agenda even further. Can you explain that to us a little bit? What are some of the key differences across markets that might be pushing more activity to one market versus another? Or are you seeing any geographies come out on top right now?
Yeah, I think if there's anything I've learned over the past 12 months, it's that when it comes to just about anything in the IRA, the devil really is in the detail. And certainly a trap, I think you're right about this, the trap that I've seen a lot of studies on the IRA fall into, especially those that look at US-wide impacts, is, basically failing to take into account some of those very local, real-world constraints, which can, I think, sometimes lead to overly optimistic projections for the speed of renewables deployment across the country. So, when it comes to specific markets, I think one of the challenges you rightly mentioned is interconnection queues. I'm sure many of our listeners will know one of the biggest issues in US power markets right now that almost all system operators are facing to some degree is just how to get through the sheer number of projects that are applying for grid connections. So according to some of the modeling we've done in markets like CAISO, in markets like PJM, where some of those backlogs are particularly pronounced, perhaps where the ambition for renewables deployment was already high, we find that the IRA doesn't actually result in a huge boost in renewables deployment, at least in the short term in the 2020s, compared to our sort of pre-IRA baseline. If you compare that to somewhere like ERCOT, where the interconnection process is generally much faster, the short-term impact in the 2020s is much more pronounced. So I think that's right. Interconnection queues are certainly one factor. I suppose you could also think about regional differences in terms of where IRA set incentives have the highest marginal impact on project economics. So in a market like MISO, for instance, where relatively few states have ambitious renewable portfolio standards, lack of carbon pricing, the tax credits from the IRA, the new incentives, can really be the difference between projects penciling or not. So we see that IRA having a pretty major impact on deployment, both in the short and long term. And that's something we're already seeing reflected in the projects applying to interconnection queues. Purely anecdotally, if I think about the project financings we've been involved in over the last 12 months, there's been a pretty high concentration across ERCOT and CAISO, especially for battery, solar, and wind. I think, though, that's largely a reflection of market maturity. The economics just look really good in those regions.
Yeah, no, I agree with you, Oliver. It's and Julia as well. Your point about almost it being like investing in different countries in the United States. I think that's one of the things that's the most challenging for me to educate clients who are investing in the U.S. for the first time, is that there is not one centralized independent system operator, regional transmission operator, and that while FERC does oversee the markets, that each market is different. The entire U.S. is not covered by one market, and it's constantly changing. Right? ERCOT was the place to be 2 years ago, from certainly solar development, and had been previously wind, and you have a disruption like Winter Storm Uri, and it sort of changes the market. And it's fascinating to see how many clients have said, I'm out, I'm not interested in ERCOT anymore. And others have doubled down and said, well, I think it actually presents an opportunity to, and the day ahead pricing being so dramatically different than day of pricing and scarcity pricing not working out the way that everyone would expect in a peak heat season like this summer. It is definitely challenging in all of the markets to find an opportunity. But oftentimes, if you talk to sponsors, they'll say a certain amount of disruption in the market is good for business because it provides an opportunity.
I might actually pick up on that particular topic and bring in Oliver here on market redesign, because like you've mentioned, a lot of ISOs across the US are needing to react to that and to understand how do we prepare each independent system in order to meet some of those reliability challenges, meet the new realities that we're facing. Oliver, can you walk us a little bit through what's going on, for example, in Texas right now? That's an example market that's going through reform. What type of conversations are we having here, and how are our clients dealing with some of that uncertainty?
Yeah, this is not a conversation we would have been having a couple of years ago. I think, at least up until 2021, ERCOT was probably seen as a market with one of the lowest levels of regulatory risk in the United States. So if we had Pat Wood on the show a while back, since deregulation in the 90s, which he played such an important role in, basically until Storm Uri in February 2021, I think we've had pretty remarkable policy and regulatory stability in ERCOT. Of course, there's nothing like a huge blackout to shake things up a little, and it's really hard to overstate just how disastrous Uri was. We probably need a whole show, maybe even a whole series, to cover the policy response over the last couple of years, but it's been fairly chaotic, to say the least. It's probably important to point out first up, though, that I don't think any market design in the world could have kept the lights on during Uri. We don't really have time to go into the details, but it's very hard for any system to cope with losing half its gas capacity in the middle of a 1 in 100 year storm in a system that's usually a summer peaking system. So, hugely challenging set of circumstances. And consequently, a lot of the policy response has been, I think, fairly appropriately targeted at some of the sort of operational issues around Uri and making sure some of those mistakes aren't repeated again. But I think it has also, as you say, opened up what is now a much broader debate around the extent to which the energy-only market design is providing sufficient incentives for dispatchable generation that in, certainly all of our analysis, we think is much needed as the grid evolves. So there have been lots of twists and turns. And, with respect to all of our colleagues and friends in ERCOT and the PUC and the legislature that have all been working really phenomenally hard over the last 24 months, it is a little bit like having too many cooks in the kitchen at times. And I think what we've ended up with, certainly from the legislature, is a little bit of a policy grab bag. So, you've got low-cost loans for thermal generators. You've got the performance credit mechanism, which is, essentially, and to put it bluntly, the end of ERCOT's energy-only market, in that it rewards generators for capacity, not just energy. We have a new ancillary service, DRRS. We still have scarcity pricing. Frankly, it's fairly unclear how all of these things will work together. And speaking with market participants, I think, there's a whole lot more uncertainty in the market than there was 12 months ago. So, I was in Houston recently, and even some of the larger thermal generators that I was speaking to, who ostensibly have most to gain from the policies, are still in wait and see mode. It's sort of putting new investment on hold till the dust settles a little bit more and there's a bit more clarity on how some of these things shake out, how the policies will be designed. But I think it's an interesting question. Look, ERCOT's booming right now. It's probably where we see a lot of commercial activity. But now that the legislature has actually proven itself willing to intervene in the market, it's hard to see how that doesn't push up, cost of capital a little to reflect that increased level of regulatory risk.
I'd love to bring in Carl on that piece, because in project financing, we speak very frequently about risk, right? And that's one of the main concerns that you need to have on your mind. Oliver, you mentioned a couple different types and a couple of types that have come up throughout the conversation. We just mentioned regulatory risk, but you did also mention, for example, just weather, right? We had Winter Storm Uri that we just spoke about, but Winter Storm Elliott in the Northeast last December, where we had about 25% of PJM's capacity that was unavailable. We had generators based on that face about $1.8 billion in fines. So, Carl, how do you think about that level of risk in your space, or how do you help your clients prepare for risk?
It's a great question. We are obviously very focused on it. I guess the first thing we do is we make sure we have the right advisors and consultants in place to help us and analyze that risk at the very beginning. But we are definitely, we'll talk about ERCOT first, and then we'll talk about what happened with Elliott second. But ERCOT, we've always, where we've seen the risk is more so in the transactions that had hedges that were settling and they went wrong against our borrower. This is why project finance lenders are focused on the best sponsors and the best projects, because we know that risk is there and prevalent, and so but what it has done is increased the scrutiny of banks' credit departments to do a deeper dive on the diligence. And we've seen some of the structures change. We're not seeing as many hedges anymore. We're seeing more corporate PPAs. We are seeing different hedge structures, but obviously we're making sure that we've learned from our experiences there. But I think on the the sponsorship side, it's making sure that sponsors have liquidity to stand behind these potential large liabilities that could be faced. But we're still very active in Texas. So we were just making sure that we're structuring the deals correctly. And then Elliott was obviously, I think, something that caught a lot of people off guard, at least on our side. We were surprised with some of the liabilities that the projects were facing. And once again, if they're structured correctly and they have enough liquidity, or that we have good sponsorship that will stand behind the projects, then that is key. And once again, we're looking, we're doing our homework around all the the contractual structures, and we'll spend more time on due diligence. But it has been added to the checklist for risk analysis that we're looking to make sure there's mitigants in place.
Right. And I suppose this is where we get back to the market design question again. I have some of my clients in PJM, for example, who knew that you could face that type of penalty risk in the capacity market and therefore weren't participating for that reason in the first place, and are now revisiting that with some of the reform processes that are ongoing that might be capping, for example, those penalties. Ron, anything you'd want to add on the contracting structure or the level of risk going forward?
Well, I think just to Oliver and Carl both hit on Texas. I mean, for a period of, I'd probably say 6 or 7 years, every deal that I was doing for the most part was a fixed shape volume hedge, right? Is the way you could get the most underwriting capacity or sizing on your debt, because you'd have a trading shop typically be able to say, well, if I know that you'll deliver this amount of electricity at this time and at these prices, then I can, based on historical markets, know how I can sort of arbitrage that. And an event that no one could, I'm a born and raised Houstonian. If you would have told me that we would have had that kind of weather in Texas at that time of year, I understand it's still winter, but I used to joke there's only 2 seasons in Texas, hot and hotter. And to have that event and find yourself in a situation, as Oliver said, where 50% or is it 25% of the capacity of gas generation couldn't deploy, that's just hard to predict. And then similar with Elliott, I mean, I recall having a conversation with one of my good clients who's now a solar and wind developer, previously a thermal developer, as many of us know. People start to pivot, but they explained the circumstances in which they were unable to generate. And it was a rain and a drop in weather so dramatically in such a short period of time that the turbines faced mechanical deployment issues that no one would have ever anticipated, because you don't typically drop 50 degrees Fahrenheit in weather over a 3-4 hour period. And so it's interesting that, as Carl notes, we got to have that checklist. And then sometimes it's the things that you don't even think could ever happen that come out. So the sponsor, and as Carl said, this is really a relationship business, because at the end of the day, you need to know people are invested in their project, because there's just so much in our environment now that we just could not predict.
You can't foresee. Exactly. Yeah. I might segue that, Ron. I think that's a really nice segue to talking, for example, about batteries, because those become increasingly important as we do see increasing volatility. And as you were talking about before, we've historically been in an environment where PPAs have been settled ahead of time. There's been a lot of predictability in those revenue streams, but I think we're all familiar with the fact that that door might be opening up a little bit more. So Oliver, let me bring you in here to talk about batteries as an increasing interest area, both pre-IRA, but certainly now also as the team has already alluded to, with more opportunities post-IRA. Where are those particularly interesting? What type of strategies are we seeing for batteries right now?
Yeah, and to bring it back to the question around market design, I think the best market design for batteries is always going to be one that appropriately rewards some of the things that they're able to do particularly well. So their flexibility, the multiple services that they can provide to the grid. So batteries are fast responding assets. They can ramp up and down with sub-second response times. That characteristic makes them extremely valuable for managing grid stability as we roll out more renewables. So you need markets that reward that. So two common features we tend to see in markets, not just in the US, but around the world, that deploy a lot of batteries are, so one, good fundamentals, by which I generally mean high levels of renewables deployment, and especially solar. And two is well-functioning ancillary service markets that reward that flexibility. So if we look at the US, both of these factors are fairly evident in places like ERCOT and CAISO, so two of the most attractive market for batteries. Even though at face value in terms of market structure or overall philosophy, they're about as far apart as you can get. So, energy only, minimal intervention, at least historically in Texas, compared to capacity market, high appetite for state intervention in California. But beyond those two factors, renewables deployment and ancillary service markets, I think some of the nuances of specific markets definitely play an important role in determining what sorts of batteries we see and the types of capital that are going to be supporting the project. So if we take those two examples again, in ERCOT, you're pretty heavily reliant on revenues derived from scarcity pricing. That in turn drives high ancillary service prices. You naturally see short duration batteries and investors with slightly higher appetite for merchant risk. In CAISO, where you have RA contracts, they drive longer duration batteries, and the fact that at least some of your revenue stack is contracted can make it slightly easier to get debt onto the back of projects.
That's probably a great point to bring in both Ron and Carl on the different financing structures there. Carl, are you seeing an increasing willingness to take on some of that merchant risk? I mean, in a case where what Oliver mentioned, all of those market fundamentals are in place and you've been sufficiently convinced of that. I know in our European podcast, that topic came up about some creative contract structures or an increased willingness to take on this type of technology or merchant risk. Do you think that's the case here in the US as well?
Yes, I think over the last couple of years, we've seen the market transition into a market where lenders are continuously being asked to take on more merchant risk. It's more in tune with at least on the lender side, sizing the loan, utilizing merchant cash flows. We first saw it on the the solar side and maybe a little bit, and also on the wind side, where we were when the energy prices started to get very competitive, in order for the returns to work for our clients, the lenders needed to come up with some more leverage to help our clients get the returns they needed. So, and I think what the we always saw the merchant sizing and merchant quasi merchant deals on the thermal side, but then we saw that and then transition over into the renewable side. So we are seeing that. We've adopted a risk appetite framework that where we have got guidelines to lend into that space. Now, keeping in mind that the U.S. is a mini perm market for the most part today, so there are certain sensitivities that we have to run, and we have certain toggles that we have to hit make sure that we keep within our framework. And I think the important thing to note is that every bank has their own framework of how they can make these deals work. What is very interesting on the renewable space is, at least on the gas-fired thermal space, where you would see a fully contracted gas deal, then you compare that to a quasi-merchant gas deal. Banks are getting paid for that risk. There's a significant delta between the credit margins, where on the renewable side, it almost looks like it's all very tight contracted cash flow stream. So we're financing off of. I think batteries is just to transition a little bit into the batteries. We are starting to see that also take effect on the battery deals. But we do love those long those RA contracts or the long capacity contracts. Those are great. But we are seeing our clients, especially in markets like ERCOT, wanting to have some of the upside related to some of the demand for these batteries, and so they're opting to do minimized contracting, which obviously creates a little bit harder of a story for banks' credit departments. But there are people lending against the merchant batteries out there.
Just following on Carl's theme, just because it's fascinating to me, the concept of merchant in our space, right? When I started this 25 years ago, if I approached someone like Carl and said, "Hey, I've got a client who has a merchant project, would you be interested in financing it?" He'd ask me if I was serious, if I really knew what I was doing. And the industry does, I guess, have to a degree, a short memory, and we've cycled back. We haven't gotten to fully merchant thermal assets, and the thing that sort of spooked the market years ago, but it has been interesting to watch this progression. As Carl described, there was the quasi merchant, which is essentially having a fully contracted asset, but giving it an amortization schedule that would go beyond the term of the debt, so that you would have what we call the merchant tail. So you're just assuming that the amount of the debt at the end of the life of the asset would be sufficient to be taken out by someone who views the value in the asset. And then we started to move into, and typically solar, this progressed mostly in the ERCOT market. And then you started to move into, okay, well, maybe we should have a little bit merchant during the term of the debt, because we're losing out on the scarcity pricing. We're losing out on the upside economics. And so some pressure was put on the banks in that regard. And so, a structure, as Carl says, every bank had a different attitude towards it, but some sizing for merchant, but based on a discount off of the forecast, or a higher coverage ratio. And then with Uri, I was fortunate enough to work with a client who closed a fully merchant project. Now, they thought that was going to be the market design going forward, and unfortunately, as we saw the pricing on PPAs go up, they've sort of stabilized, at least in ERCOT and for renewable projects, and now the forecast going forward showed a little bit less. So it's this constant push and pull, right? The sponsors don't want to give up the economic upside. From a project finance lending perspective, you need to have some comfort with respect to not just the relationship, but also that there's a base of economics. Battery storage takes on a whole new, I guess we're going down a whole new path. I think Carl and SMBC were fortunate to be involved in a very early project financing of battery storage in the California market, where there was contracting and some credit given to ancillary services. But now, as Carl said, people are interested in having a substantially merchant asset in markets like ERCOT where it makes sense. So you have to figure out, how do you diversify the risk? Maybe a portfolio basis, maybe a holdco loan, maybe through coverage or sweeps or toggles, is some leverage of hedging. So it's fascinating to watch the market move into the merchant space, but I feel like everyone's approaching it, especially with tax equity participating in batteries now. I feel like there's more than one voice than just the lender saying, "Hold on, we need to rethink this."
And it certainly touches on our earlier theme, exactly that as you open up access, you start to be more creative, and it will look different across every single market. You all have touched a little bit on thermal generation too. I know we started out today talking about renewables and now battery generation, but I think we'd be remiss not to spend a little bit of time on thermal generation, because certainly if we look at the Aurora forecasts or many forecasts out there, there is a role for thermal generation going forward. That faces increasing uncertainty. We've seen a number of new rules, both at the federal level, for example, from the EPA, but then at the state level as well, that starts to push offline some of those technologies. What does that look like going forward? Maybe Carl, let me pass that one to you. Do you see a willingness still to bring online new generation, or maybe invest in existing thermal generation, or has that completely turned away?
Yeah, I mean, this is another hot topic in addition to the IRA that we battle with every day. I think if you talk to the experts, they'll tell you that gas is not going away. We need it, but there's a lot of pressure from the NGOs and others that are pushing banks and corporations and their boards to focus on ESG and transition to clean energy. But it's not going to we think it's not going to happen overnight, and we do view gas as a transition fuel, and we view it as hugely important. And I think what we have seen lately is we've seen less new builds, and there's still a couple out there, but there's I think where we're going to see it be very interesting is when a lot of these mini perm structures come maturing on the gas side. There's going to be a lot of refinancing opportunities in the space, and we think they're great assets, but we are also under pressure to reduce carbon exposure, and us and everybody else, so we're not alone, but it's something that we're managing. We are tracking it very closely. Our management's tracking it very closely. They're setting internal goals, and we've seen people pull out. We've seen some of our peers, say that they're not going to do gas anymore. But I still think that there are a lot of lenders out there that are, continuing to support the financing of gas-fired plants, I think it's something that will play out, more and more over the next year or two as we start to see some of these large gas deals that were done on a five-year tenor, start maturing. It will probably open up, the market. It'll probably go into different markets like the Terminal B market. So I think that there will be homes for these deals, but I think they're great assets to finance. So I'm just hoping that we can, still maintain our goals and still support, that part of the energy stack.
It's something we're watching very closely, certainly, because exactly to Oliver's point before about markets becoming increasingly aware of resource adequacy risk, of what happens in some of these extreme events. There's conversations on how do you actually incentivize more of that dispatchable technology to be available when you need it. And depending on the various conversations in different states, some of that is very, very likely going to be gas generation. So we're keeping a close eye on it, and we'll see what new generation gets financed and built out there. No, we're coming up on the last couple of minutes here, but I do want to pivot us to one more technology. We've spoken about a lot of existing technologies that have been in the space for a while. Ron, I know you, for example, have been quite active in the hydrogen space, and that's particularly interesting now with the Inflation Reduction Act, because it touches on two of those topics, and that it gives us both increasing certainty, and there's still quite a lot of uncertainty exactly what the future of hydrogen looks like going forward. What have you seen in terms of increasing investment in hydrogen? Does the U.S. start to become a big global player now in the future?
I know I've used the word fascinating several times during this podcast, but I've never been so excited about the sort of energy market in the US and globally in my career, because never at one point in time have we had so many different types of resources and technologies and opportunities to explore different means of generation, carbon reduction, et cetera. If you had asked me in January or February, after having just moved over to Linklaters, and part of the purpose was to have a international footprint with the leading project firm and to really understand the rest of the world, who, to be frank, has been ahead of the U.S. in most of the transition space to date, I would have said that the U.S. is not a major player in the hydrogen space. I just don't see the demand. I mean, there's some interest in fuel cells. There's need for hydrogen to the extent that you're converting the hydrogen to ammonia, but not on a pure hydrogen play. And then I spent time in the Asian markets with my colleagues in our practice groups out there, and was astonished to realize that there is a huge demand for hydrogen in other parts of the world that it is likely to be supplied by the United States. As a result of the IRA, the economics on hydrogen projects have been transformed dramatically, such that it makes more economic sense to ship hydrogen from the United States, likely out of the Gulf, to the Asian markets to serve their needs to reduce carbon on existing and hard to replace coal facilities. And that's just astonishing to me. But we've seen it in several projects that have been announced. I know Carl and SMBC have seen several opportunities, and I just anticipate it to grow tremendously. And this is an example of where it is clear that the IRA was the genesis behind this interest in the U.S. hydrogen market.
Great, thanks. And I know we've talked about Texas quite a few times today, but certainly another geography we'll keep an eye on for the hydrogen space.
The Louisiana people would say, "Don't forget about us as well."
That's right. We can call it the Gulf Coast.
Exactly.
Roughly. make it more inclusive. Wonderful. Well, you mentioned some great examples of what you're excited about and what's going well, Ron. So I'd love to wrap up with a rapid fire question for all three of you, which is, what did the U.S. get right with this policy? What do you think in general makes us, or can continue to make us, a global leader in industrial or in energy policy? Ron, let me maybe pass that right back to you, and then I'll pass it to Oliver and then Carl.
I think being the glasses half full and optimist, which lawyers aren't usually good at, but I try to be, is the U.S. got the diversity of the IRA right in terms of just not just coming at one particular technology or one particular resource, but really trying to build a framework that provided for a lot of different opportunities to bring in capital, to provide, I put into this as well, the DOE loan programs and the grants. And, it is without question probably the most comprehensive, certainly in the U.S. history, as we know, but maybe global, policy and program around energy transition. With that comes a lot of complexity and challenges and uncertainty, and at least in terms of deployment and how capital providers can get comfortable. But I'd sure rather have that than a very narrow and not as broad of an opportunity for us, because the future is uncertain. So this gives us a lot of different ways, a lot of tools in the toolbox, as they like to say.
Thanks, Ron. Oliver, you want to jump in and add your takeaway?
Sure. I think the answer for me is that it's just such a great example of industrial policy. I think, it's interesting historically. I think there's been something of a consensus across the political spectrum, not just in the US, but in Europe too, around, the importance of and central, around the importance of globalization. Then we had COVID, we've had the energy crisis in Europe. We've had a general push to reduce reliance on countries like China. So I think, to me, the IRA is in a lot of ways emblematic of a broader shift away from sort of straight up globalization towards a more comprehensive and domestically focused industrial policy that really tackles the whole value chain, right from upstream manufacturing through to incentives for deployment. So I think the sort of comprehensive nature of the policy in that regard is something that I think is key to its success, and it's something that we're now starting to see in Europe too, taking a leaf out of the US's book.
Yeah, I mean, I echo Ron and Oliver on on other points, and just to kind of touch on, it gave the extensions for the businesses that we were the most directly involved with, i.e. wind and solar, and then expanded it to battery, which I thought was that was a huge a huge shot in the arm to help the battery business get off the ground. And then it expanded into other areas that we, or I would say less traditional project finance areas, but now will become project finance areas like carbon capture, and then renewable fuels. That we have a separate department that just focuses on new energies, and that picks up all the pressure that the oil and gas industry was under. They at least have a window or an avenue to look at to try to play in the space. And there's tax credits across all the different types of energy markets. And then just to kind of go back on hydrogen, it kind of gave a boost to the hydrogen business, and you're seeing deals pop up all over the place. And I think the other, let's also think about the fact that I think the goal also was to get rid of the bottleneck on the tax equity side, because I think that obviously, but with that said, there's still the traditional tax equity deals that are going to be there, so that people have a way of monetizing their makers, et cetera. But I think that it opens up the market more and gives it a little bit more flexibility around structuring and financing. But we're excited about what's to come in the next few years, and I think we're just going to have to handle the growing pains that come along with it.
Right. It's been great to hear the optimism across the board, Ron. I think I really enjoyed being able to tease out both the fact that we were already on a very exciting trajectory, like Carl kicked us off with it at the beginning, but that things are continually changing and growing in the United States. Excellent. Well, I think that's a great place to wrap up for today. I've really enjoyed teasing out some common themes that we've seen globally in our project financing conversations across Asia, Australia, and Europe, but it's been a lot of fun as well to talk about some of the peculiarities of our very large country over here in the United States as well. So thank you so much to my three guests for joining me today. Thanks a lot, Oliver.
Thanks, Julia.
Thanks for joining us, Carl.
Thank you.
And thanks a lot, Ron.
Thank you, Julia. I want to tell you that this was a pleasure, because until this gets published, my kids think I'm cool now because I told them I was doing a podcast. So once they hear it, they may not want to, but or may not have the same view. But in all seriousness, really appreciate it. It's been fantastic.
Great. Well, I think, Ron, podcasting is a bucket list item for many of us.
Box checked. Thank you.
Thanks, everyone.
That was Julia Hoos, who's Aurora's head of USA East, talking to Carl Morales, Managing Director and Group Head for SMBC, Ron Erlichman, Partner and Co-Head of Energy and Infrastructure in the Americas for the law firm Linklaters, and Oliver Kerr, who's head of Aurora's North American business. Do keep an eye on our podcast feed for more in-depth conversations with senior members of the energy industry. The best way to do this is to subscribe on whatever platform you use. Thanks for listening, and goodbye.